When CEOs are looking to raise capital, they often focus in on the price, the valuation of the business, and that's their primary focus. And that's a mistake. Yes, price is important, but it's not the only thing that's important to look at. When you're talking to prospective investors, they're going to want to have specific terms and conditions as part of the deal that will impact how much money you end up with at the end of the day. As an example, they're going to look for a preferred return. They might want to say, hey, I'm going to get twice my money out before you take a dime. And that's a big deal to your own shareholding, your own wealth, as well as the investors that you've already raised capital from to date. Another example would be veto rights. They're going to have veto rights over specific items about how you run the business. So when you raise capital, especially from an institutional investor or venture capital firm, you're giving up control. And you have to be okay with giving up that control because they're not going to allow you just to do anything you want like you were before. So if you want to go into a new line of business and it's going to cost a lot of money, you're going to have to go to your board and you're going to have to go to your investors and get them to authorize that before you just dive in. These are just a couple examples of where you need to have a good advisor working with you side by side to help guide you through the steps and the terms and conditions that an institutional investor will demand and how you can negotiate the best possible deal given those demands.